Stop what you are doing right now. If you are a single homeowner on the age pension or getting close to applying for one, what I am about to tell you in the next few minutes could save you thousands of dollars a year. The rules have shifted. The $722,000 cutoff for a single homeowner is now in effect, and I am seeing far too many Australians lose their part pension simply because nobody told them this in plain English. Your hard-earned pension is on the line. And the worst part? Most people do not even realize they have crossed the threshold until the letter from Centrelink arrives, and by then, it is already too late. Now, before we get into the numbers, and we will get into every single number, I promise you, I need to say something important. I know how stressful these Centrelink letters and rule changes can be. It feels like the goalposts are always moving. You have worked hard your entire life. You have paid taxes. You have done everything right. And now you are sitting there wondering, am I still eligible? Did something change? Why is my payment different this fortnight? I want you to know, I am standing right here with you. You are not alone in this. Now, today I need your advice. This channel, Centrelink Support Hub, is for you. It has always been for you, and I want to make sure I am tackling the issues that keep you up at night. I read every single one of your comments, and honestly, it brings me so much joy to connect with you all. Your stories, your questions, your wins, they are the reason I show up here every single week. So here is what I want you to do right now. Tell me in the comments section below. What is the #1 problem you are facing with Centrelink today? Is it a payment delay? A confusing assets test letter? A rejected claim? Are you worried about how your superannuation is affecting your pension? Or maybe you are just not sure if you even qualify anymore? Tell me your story. Write it in the comments right now. I personally go through every single one. I reply to as many as I possibly can. And, most importantly, I base my very next video on the issue that gets the most mentions. We are in this together, and together we will find the solution. But before we dive into your requests, we have to talk about today's critical update. Because this $722,000 threshold, it is a trap that thousands of Australians are falling into right now, and most of them do not even know it yet. Let us fix that right now. Welcome, or welcome back, to Centrelink Support Hub. I am John, and this is the channel where we cut through the confusing government language, the fine print, and the red tape, and give you the clear, accurate, plain English answers you deserve. Every single week, we cover age pension rules, Centrelink payments, assets tests, income tests, and everything in between, all verified directly from official government sources like Services, Australia.gov.au, and the Department of Social Services. Now, if you are new here, welcome to the family. Hit that subscribe button right now. It is completely free, and it means you will never miss a critical update like today's, updates that could directly affect your fortnightly payment. And if you find this video helpful, and I genuinely believe you will, please give it a thumbs up. It helps other Australians just like you find this information when they need it most. All right, let us get into it. Let us start at the very beginning, because I want to make sure every single person watching this video understands exactly what we are talking about. When you apply for the age pension in Australia, Centrelink runs 2 separate tests to decide how much you receive, or whether you receive anything at all. These are called the assets test and the income test, and here is the critical part that most people miss. Centrelink does not just pick one. They run both tests, and then they pay you whichever result gives you the lower pension amount. I know, it sounds harsh, but that is the law. And understanding this is the key to protecting your pension. Now, today we are focusing on the assets test, specifically the cutoff for a single homeowner. So what exactly is an assessable asset? An assessable asset is anything you own that has financial value, with some important exceptions. This includes your superannuation balance once you reach age pension age, your bank accounts and term deposits, your shares and managed funds, any investment properties, your caravans, boats and vehicles, and your household contents and personal effects. But here is the big one. Here is the exemption that everyone talks about. Your principal place of residence, the home you live in, is completely exempt from the assets test. That means if you own your home and live in it, Centrelink does not count its value when assessing your eligibility. Now, that exemption is good news. But here is where people get caught. Because your home is exempt, the government applies lower asset thresholds to homeowners than to non-homeowners. They reason that you already have significant wealth in your property, so your other assets are judged more strictly. And that is exactly where the $722,000 figure comes in. From the 20th of March 2026, the most recent indexation, here are the official assets test thresholds. If you are a single homeowner, the full pension lower limit is $321,500, and the part pension cuts off completely above $722,000. If you are a single non-homeowner, the full pension lower limit is $579,500, and the cutoff is $980,000. For a couple who are homeowners, the combined full pension limit is $481,500, and the cutoff is $1,085,000. And for a couple who are non-homeowners, the combined full pension limit is $739,500, and the cutoff is $1,343,000. These figures come directly from the Services Australia website, servicesaustralia.gov.au, updated on the 20th of March 2026. Let me translate this into plain English. If you are a single person who owns your home and your assessable assets are below $321,500, you qualify for the full age pension. Brilliant. If your assessable assets are between $321,500 and $722,000, you qualify for a part pension. Still extremely valuable. But if your assessable assets go above $722,000, your part pension is canceled. Gone. Zero. Now, I want to show you a real-world example, because numbers on a screen do not always feel real until you see a person's situation. Meet Margaret. Margaret is 70 years old. She is a single homeowner living in regional New South Wales. She has worked her whole life, and she owns her home outright. Her other assets, her super, her savings, a small share portfolio, total $715,000. Under the OLD cutoff, which was $714,500 before March 2026, Margaret was $500 over the limit. She received zero part pension. Nothing. Then, on the 20th of March 2026, Centrelink indexed the thresholds upward. The new cutoff became $722,000. Suddenly, Margaret qualifies again. She is now entitled to approximately $60.70 per fortnight. Now, $60 a fortnight might not sound like much, but here is what people forget. With even a single dollar of part pension comes the Pensioner Concession Card, and that card is worth potentially hundreds of dollars every year in healthcare discounts, transport concessions, utility rebates, and council rate reductions. So if you are in a situation similar to Margaret, you need to check whether the new $722,000 cutoff now makes you eligible, because thousands of Australians are in exactly her position right now, and they simply do not know it. Now, I need to warn you, because the $722,000 cutoff is just the beginning of the story. There are several hidden traps in the system that catch people completely off guard, and I want to go through every single one of them with you today. Trap number 1, the dual test ambush. Here is the mistake I see most often. A pensioner checks their assets. They see their total is, say, $680,000. They are well under the $722,000 cutoff, so they relax. They think, I am fine. My pension is safe. But remember what I told you at the beginning? Centrelink runs 2 tests and pays you the lower result. Even if you pass the assets test perfectly, the income test might still be reducing your pension. And the income test works on something called Deeming, which brings me to trap number 2. Trap number 2, the Deeming trap. This is one of the most misunderstood rules in the entire pension system. Here is how most people think it works. They say, John, my term deposit earned almost nothing last year, so my deemed income must be low, right? Wrong. Centrelink does not care what your investments actually earn. Instead, they apply what are called deeming rates, fixed percentages that assume your financial assets are earning a standard return, regardless of what they are actually doing. From the 20th of March, 2026, the deeming rates are as follows. The first $64,200 of a single person's financial assets is deemed to earn 1.25% per year. Anything above $64,200 is deemed to earn 3.25% per year. For couples, the lower rate applies to the first $106,200 combined. So, if you have $400,000 in super, even if it earned nothing this year, Centrelink assumes it generated thousands of dollars in deemed income. And that deemed income is counted against you in the income test. This is why some people with well under $722,000 in assets are still getting a reduced pension, or no pension at all. The income test is biting them before they even reach the assets cutoff. Trap number 3, the gifting trap, the $10,000 and $30,000 rule. I get asked about this constantly in the comments. John, can I give money to my children to reduce my assets and get a higher pension? And the answer is yes, but only up to strict limits. And if you get this wrong, Centrelink will penalize you anyway. And you will have given your money away for nothing. Here are the official rules. You can gift up to $10,000 per financial year without penalty, and no more than $30,000 total over any rolling 5-year period. Now, here is where it gets dangerous. If you give away more than these limits, say you gift $50,000 to your daughter this year, Centrelink will still count that $50,000 as your asset for the next 5 years. They call this deprivation, and it applies even though the money is gone. On top of that, they will also apply the deeming rate to the excess amount for the income test. So please, before you gift anything to family or friends, call Centrelink on 132300 and speak to a financial information service officer first. It is free, confidential, and could save you a very costly mistake. Trap number 4, the Downsizer contribution backfire. This one surprises a lot of people. Many retirees decide to sell their family home and downsize, maybe move into a smaller property or a retirement village. And they hear about the Downsizer contribution, which allows you to put up to $300,000 per person into your superannuation from the proceeds of selling your home. That sounds fantastic. A big, tax-effective top-up to your super. But here is the trap. Your family home is exempt from the assets test. Your superannuation is not. So the moment you sell your home and put the proceeds into super, that money moves from an exempt asset to a fully assessable asset. For some people, this can push them over the $722,000 cutoff, and they lose their part pension entirely. This does not mean you should never downsize, but it does mean you must model out the numbers, ideally with a licensed financial advisor, before you make any decisions. Trap number 5, the 14-day reporting rule. This one can turn into a real debt nightmare if you are not careful. If you are already receiving a full or part-age pension and the value of your assets changes, you are legally required to notify Centrelink within 14 days. This includes inheriting money or property, selling an investment, receiving a lump sum payment, or your superannuation balance increasing significantly. If your assets increase past the threshold and you do not report it, and Centrelink overpays you, they will recover that money. They call it a debt, and they will begin deductions from your future pension payments. This is one of the most stressful situations pensioners face, receiving a debt notice for overpayments when they simply did not know they needed to report a change. So please mark this clearly. Any change to your assets, report it to Centrelink within 14 days. Trap number 6, losing your Pensioner Concession Card. Many people think, John, if I am only going to get $60 or $70 per fortnight in part pension, it is probably not worth the bother. I strongly disagree, and here is why. With the Pensioner Concession Card, which you qualify for even on the smallest part pension, you receive access to bulk billed medical appointments, reduced cost prescriptions through the Pharmaceutical Benefits Scheme, energy supplements and utility rebates, public transport concessions in most states, council rate reductions, and more depending on your state or territory. The combined value of those concessions can easily exceed $1,000 to $2,000 per year, far more than the part pension payment itself. So if you are sitting just below $722,000 in assets and you think it is not worth applying, please reconsider. The card alone is worth your time. Now, let us spend a few minutes on the income test. Because remember, Centrelink runs both tests, and I want you to understand exactly how the income test could be affecting your payments even if your assets are well under $722,000. From the 20th of March 2026, these are the official income test-free areas. A single pensioner can earn up to $218 per fortnight and receive the full pension. A couple can earn up to $380 per fortnight combined and receive the full pension. Above those figures, the pension reduces by 50 cents for every dollar of income over the limit. The maximum pension rates as of March 2026 are $1,200.90 per fortnight for singles. That is approximately $31,223 per year, including supplements. And for couples combined, $1,810.40 per fortnight, approximately $47,070 per year. And when it comes to financial assets, remember that deeming applies. Your bank accounts, your super, your shares, your term deposits, all of these are deemed to earn income at the fixed deeming rates I mentioned earlier. And that deemed income counts against you in the income test, even if your investments are actually performing poorly. This is why it is so important to understand both tests, not just one. And this is why I always recommend that if you are even close to a threshold in either test, you contact the Financial Information Service for a free personal assessment. Now, I want to take a moment, step back from the numbers, and tell you why this matters so much. Right now, in 2026, Australia's cost of living has not been easy on retirees. Energy bills, grocery prices, medication costs, they have all gone up. And for millions of Australians who are on a fixed income from the age pension, every single dollar counts. The good news, and there is good news, is that the indexation on the 20th of March 2026 raised the thresholds. More Australians are now eligible than before. People who were just over the cutoff 6 months ago might now be eligible for a part pension. But, and this is critical, Centrelink does not automatically contact you to tell you that you are now eligible. If your previous claim was rejected or canceled, you need to reapply. Or at minimum, contact Centrelink to have your situation reassessed. And for those of you who have never applied, perhaps because you assumed your assets were too high, please reconsider based on the new figures I have shared today. The question I want you to ask yourself right now is this: where do your assets sit today compared to that $722,000 mark? If you are anywhere near it, within $50,000 either side, this video is essential viewing for you, and I strongly urge you to take action today. All right, let us get practical. Here is exactly what I want you to do, step by step, after this video ends. Step 1. Calculate your assessable assets. Sit down with a pen and paper or a spreadsheet and list every asset you own except your family home. Include your superannuation balance, bank accounts and term deposits, shares, ETFs, and managed funds, investment property values minus any debts against them, the estimated value of your car and household contents, and any other financial investments. Add them all up. That is your total assessable assets figure. Then compare that number to $722,000 if you are a single homeowner. If you are under it, even by $1, you may be eligible for the part pension. Step 2. Check the official Centrelink website. Go to servicesaustralia.gov.au and search for Assets Test for Age Pension. This is the official page, updated as of March 20th, 2026, with all current thresholds. Bookmark it. Check it after every indexation, in March, July, and September. Step 3. Use the Centrelink Online Estimator. Log into MyGov at my.gov.au, link your Centrelink account, and use the Payment and Service Finder tool. This tool gives you an estimate of what you might be entitled to based on your individual circumstances. It is not a final assessment, but it gives you a very good indication before you call or visit. Step 4. Call the Older Australians line. If you need to speak to someone, and many of you will, and that is completely okay, call 132300. That is the Centrelink Older Australians line. This line is specifically for age pension, the Pensioner Concession Card, and the Commonwealth Seniors Health Card. Hours are Monday to Friday, 8 a.m. to 5 p.m. your local time. And when you call, if you want free financial information about how the rules apply to your situation, say these exact words when prompted, Financial Information Service. You will be connected to a free, government-funded officer who can walk through the income test, assets test, and deeming rules as they apply specifically to you. No cost, no obligation. Step 5. If previously rejected, reapply now. If your pension claim was canceled or rejected in the past because your assets were over the threshold, please reapply or request a reassessment. The thresholds have risen. Your situation may have changed. What was too high 6 months ago might now qualify you for the part pension. Do not assume the old decision still stands. Step 6. See a licensed financial advisor for complex situations. If you have significant assets, investment properties, business interests, complex superannuation arrangements, or granny flat arrangements, I strongly recommend speaking with a licensed financial advisor who specializes in retirement planning. The FIS line gives you information. A financial advisor gives you personalized strategy. A SIC's MoneySmart website at moneysmart.gov.au has a free financial advisor directory to help you find someone in your area. Now, I want to talk about something that not enough Australians know, and that is, if Centrelink makes a decision about your pension that you believe is wrong, you have the legal right to challenge it. The system has multiple levels of review, and it is your right to use them. Level 1. Request an authorized review officer. If you disagree with a Centrelink decision on your pension amount, eligibility, or any assessment, you can request a review by what is called an authorized review officer, or ARO. An ARO is an independent Centrelink officer, different from the original decision maker, who will look at your case with fresh eyes. To request this, call 132300 and say, I would like to request an ARO review. You have 13 weeks from the date of the decision to make this request. Level 2. The Administrative Appeals Tribunal. If the ARO review does not resolve your issue, you can escalate to the Administrative Appeals Tribunal, or AAT. The AAT is a completely independent government body, separate from Centrelink and the Department of Social Services, and it will conduct a formal review of your case. Many pensioners have successfully used the AAT to overturn incorrect Centrelink decisions. It is more formal than an ARO review, but it is a powerful right, and it costs nothing to apply. And remember, you are entitled to full information. Under the Freedom of Information Act, you have the right to access any documents, assessments, or calculations Centrelink used to make a decision about your pension. If a decision does not make sense to you, if the numbers do not add up, you can request your file. Call 132300 or submit a request through MyGov. And if you need assistance navigating this process, most states and territories have a legal aid commission that can help seniors with Centrelink matters free of charge. All right, before I let you go, let me give you the key takeaways from today. 1. From the 20th of March 2026, the part pension assets test cutoff for a single homeowner is $722,000. If you are under this figure, you may be eligible. 2. Centrelink runs both an assets test and an income test. You must pass both. The lower result is what they pay you. 3. Your family home is exempt. Your super, savings, shares, and investments are not. 4. Deeming rates apply to your financial assets, regardless of what they actually earn. 5. Gifting above $10,000 per year or $30,000 over 5 years will be counted against you for 5 years. 6. If previously rejected, reapply. Thresholds have increased and your eligibility may have changed. 7. Call 132300 and ask for the Financial Information Service. It is completely free. 8. You have the right to appeal any Centrelink decision within 13 weeks. Now, I have one final request for you. Scroll down to the comments right now and tell me. What is your number one Centrelink concern today? I am reading every single comment. I am personally replying to as many as I can. And I am building my next video based on what you tell me. Your voice shapes this channel, so use it. If today's video helped you, or you think it could help someone you know, a single person who might be missing out on a pension they are entitled to, please share this video with them. Send it to a family member, post it in a Facebook group, leave a comment below, because that is what this community is about. Looking out for each other, making sure no Australian retires with less than they deserve. I am John, from Centrelink Support Hub. Thank you for watching. Thank you for trusting me with your time, and I will see you in the next video. Take care of yourselves and look out for each other. Bye for now.